right, well, good evening, everyone.
Good evening.
Thank you. First off, we want to thank everyone for coming out in this typical cold day in Chicago this year, right? Is anybody ready for this to end?
Yes.
It's supposed to be getting warmer this time of the year, but hopefully we're almost done. It's about to end probably. So anyway, just want to tell you a little bit about myself. My name is Anthony Guerreri. I've actually been here with this organization for over 20 years. And in fact, myself and all our partners that, probably some of you are their clients or you were invited by them, we have about 200 years experience combined of working here in the financial industry and educating families really what to do with their money. And so we really appreciate you coming out. This is our second economic summit. Have any of you come to the one we had last year? Anyone here? Okay, a couple people. So this is the first one that we're having for the year, and we're going to be having these throughout the year. So please look for the next announcement that we have. And so anyway, just kind of getting back into our experience here and why we invited you tonight. When we look at the last, my personal experience, the last 20 years, how's the economy been? Up and down, right? Anybody remember 2008? How can you forget, right? I think some people have forgotten. Those are usually the people that didn't experience that. And I remember the 90s. I actually got into this industry at the back end of used to be the longest bull run in history. That was from 1990 to about year 2000. Anyone remember that one? The dot-com bust, right? First time we had the big dot-com bubble. And I remember experiencing that and going through that. And we also had a big run-up, right? We've had the ups and downs. And having experienced 3 bull markets, which when the market's up, and 2 very down markets, I've learned a lot myself. And I think tonight is a special treat because you're going to get a chance to hear from 2 industry veterans that have been actually in the industry practicing for almost 50 years, right? So they have a combined experience. So I think they're going to provide some very good insight for all of you. But I also wanted to take a minute just to recap what we do and what we offer at our company here. We're big believers in holistic planning, okay? So there's really 4 stages in financial planning. When you start out, we call that the protection stage. When you're coming out, maybe a young family, you come out of school, fall in love, maybe that happened, you get married, right? Or you have a family, maybe you don't get married, right? So that stage, that's when you generally have the least amount of wealth and you have the biggest amount of responsibility. We call that the protection stage because you got to make sure that you're prepared for the what ifs. What if something happens? What if I pass away, right? But what if I get sick? What if I become critically or chronically ill? So that's a very important stage because we have people that are dependent upon us. So we can help people in that area. But the next stage is simultaneously happening is the accumulation stage. And many of us are in that. Well, we're building up our wealth, and that's one of the reasons why you're here tonight. And there's a lot of different ways to build wealth. There's so many options, right? You turn on the TV, right? There's investments that you hear. Some people have done it with real estate. There's just so many different ways to build that wealth, right, and that accumulation. But we also provide knowledge. We do investments. We help people with those programs and tools for retirement. But then there's the third stage, which is could be the most dangerous stage. Call that the distribution stage, right? When you reach the retirement years, right? And what's the number one concern when you're retired? Anyone want to share what it is?
Running out of money.
Running out of money. Is that true?
Yes.
Longevity risk is what they call it, right? We're living longer, right? And modern medicine is keeping us alive, right? So longevity risk is a big concern, right? What's another concern in the distribution phase? What? Taxes? Healthcare. Healthcare. That's right. That's a big one, right? What if I get sick? What if I become chronically ill? What if I need home health care, right? They call that long-term care. We provide solutions in those areas as well. And what's the last phase of retirement financial planning? Distribution. Is that right? How are we going to distribute that? Do we want to pay an attorney $10,000, $20,000, $30,000 to make sure that our hard work, all the assets that we work so hard for to transfer to that next generation, or pay a lot in taxes? Of course we don't. So we also do estate planning because we work with attorneys to put together plans. So we literally do A to Z. So when we're sitting down with families, we're looking at it from the whole picture point of view. And so going forward, we'll be doing economic summits related to all those different phases. But tonight is specifically focused on accumulation as well as that distribution. right? What is the best way? What's the other concern in retirement? Longevity. We also have to deal with inflation, right? Everything is getting more expensive, so we have to make more than the banks are paying today. And what is the banks paying today in savings? 1%, maybe 2% now, right? How's that working out for a fixed income? Not very good. So you got to look at different alternatives, but at the same time, we're a little bit worried, right? What's going to happen? Is the market going to crash again? We're going to see another 2008. Well, these gentlemen are here to help us, to give us some insight, once again, provide their wisdom. So I'm about to bring them up here. I want to tell you first a little bit about Robert Fitzpatrick. And everything is in here, but I'm just going to take a minute here to just introduce them. Robert is a director and senior consultant relations manager at Conning, where he is responsible for developing and managing relationships within the institutional consultant marketplace. Prior to joining Conning in 2008, Mr. Fitzpatrick was an executive director at UBS Global Asset Management. Previous to that role, he was managing director of North America at Harmonic Capital Partners and director of global consultant relations at the First Project Health. Prior to his tenure in financial services, Mr. Fitzpatrick held senior level management positions at IBM. Mr. Fitzpatrick graduated from the University of Notre Dame. I'm a big fan, so yeah. Great guy. It's interesting, his partners from USC, they're big rivals. So anyway, he holds a Series 3, Series 7, Series 6 through license and had more than 20 years experience. The next gentleman, we're honored, of course, to have them both here, but he actually is the one who helped build this fund we're going to talk about, which is very unique. It's very rare that you have someone like this who actually come in to the field and not only talk to the advisors like ourselves, the advocates, but actually come and speak to the clients. It's a special treat. We really appreciate it. He's the director of equity strategies at Conning, where he's responsible for development and implementation of equity investment strategies. He's a member of the team that manages Conning's dividend equity strategies. Prior to joining Conning in 2015, Mr. Townsend was senior portfolio manager at Golden Capital Management, responsible for managing global equity strategies. Mr. Townsend has 27 years of experience in the investment industry, including the director of quantitative research for ING Investment Management, NA, and as a U.S. equity portfolio manager with Invesco, Aetna ING Investment Management. Mr. Townsend is a graduate of the University of Southern California, right? The Trojans, right? So literally, they're rival school, right? And with a BS in mechanical engineering, and earned an MBA in finance from Vanderbilt University. Without any further ado, let's give a big hand to our speakers. Thank you, Anthony.
First of all, I want to applaud you all for being here tonight. I know it's a cold night outside, but financial planning is not easy, right? It's, I was actually joking with Tom and Karen earlier tonight, and I just said, how many times have you heard friends say, oh my God, I know really hot stock for you? And you'll say, well, what do you know about that stock? I don't know. I just think it's really hot. And so, you say there are opportunities that are missed out there, but oftentimes, well, I would say 99% of the time, people's wealth is driven by working with a financial advisor who is your compass and your discipline, right? Because they know what your risk, aptitude is. They know what your risk profile is, and they design a portfolio that works for you. And it's very customized. What works for me may not work for, Tom and Karen, may not work for Don, but it's very customized. So I applaud you for being here and working with Transamerica to figure out, how do you retire better? We're here to talk about a strategy today, but I want to do a couple of things first. I'll introduce our firm, which is one slide, which will be very quick. And then I'm going to ask Don, who I call the professor, to talk about the economy today, because I think, we look at the economy today and it's, I guess unemployment's low, corporate earnings are up, so everything looks rosy, but I don't think it's that rosy, right? So we're starting to see volatility in the market. And there was less volatility in the past couple of years. Everything you touch seemed to go up. I don't think that's the wave of the future. And so being disciplined and focused and having that compass I talked about earlier and working with a financial advisor, hopefully get you where you want to be in life. And some of the risks that Anthony outlined, we can avoid, right? And you can never save enough, right? Because you don't know what the future's going to hold. You don't know how healthy you're going to be. You don't know how long you're going to live, and you don't know what other expenses are going to be presented. So again, applaud you for being here, because the fact you're thinking about it means you've taken the first 5 steps, not just the first step. So let me introduce, oh, you already saw that. So our organization, so we're an institutional asset manager located in Hartford, Connecticut. And being in Hartford is not a mistake. We've been here since 1912. I often talk to we're as old as L.L. Bean and Fenway Park, right? So it's been a long history of managing assets. But historically, we've been managing assets that are yield-driven strategies for the conservative segment of the market, which are insurance companies, right? So insurance companies are highly conservative. They have, they bring in premiums, and they have future potential liabilities, whether it's health insurance, whether it's life insurance, whether it's property and casualty insurance, but they need to manage those assets in a very conservative way. We've always been a very conservative manager, and we talk about high dividend equity strategy tonight. Our strategy tonight, you'll see it's conservatively driven. In this particular strategy, we have 1.5 billion in the strategy, with the exception of our relationship with Transamerica. They're all institutional assets. They're all very sizable clients, and probably if I look at the amount of money we manage for each client, it's probably roughly about $300 million. So we're taking a well thought out strategy, focusing on dividend yielding strategy, and we're doing it for individuals. We're doing it for individuals through Transamerica. We have offices in Asia, Europe, North America. We're globally, we have 427 employees. And I like this ratio, I think, is somewhat differentiating the fact that 157 of those are investment professionals. So our core business is managing money, so that would make sense to have a lot of investment professionals. So that sort of gives a breakdown of the firm. Are there any questions? I know it's a big room. There's a lot of people here. I want to make this as interactive as possible. So if you have a question, don't hesitate raising your hand. I'd rather address it when you have it versus trying to do it at the end when you may not get your question answered. So let me turn it over to Don, who's going to give you his sort of thoughts on the market, the economy, and we don't know what the future holds, but it'll have some sort of insight to what it could hold.
That's right. That's right. Thanks, Bob. Thanks. Yes, disclaimer, the economy is very hard to predict. Right? Everybody knows that. It's very hard to predict the markets and what the markets do in response to the economy. Again, it's very hard to predict. I mean, everybody remembers the fourth quarter of 2018, right? Let alone 2008. All of a sudden, nothing went up. Everything went down. And it was all because the chairman of the Fed said something different than he was going to say, but he was saying before. And all of a sudden, everybody was worried about trade deals because there hadn't been any good news for a while. And I guess the first message that I would have tonight is that the financial markets respond to bad news and good news, and they react to it, but I think more correctly, they overreact to everything. You could always expect bad news to take the markets down and good news to take them up, but I think the reality is that there are a couple of things really going for the U.S. economy right now, and therefore the stock market that tends to be pretty dependent upon the U.S. economy. That said, as Bob remarked, there are things aren't now like they were 6 or 7 years ago when just about every force in the U.S. arsenal was trying to be focused on and trying to get things to recover and drive the markets higher, whether it be really, really low interest rates or just all sorts of different easy policies. Right now, to a certain extent, I think we're benefiting in terms of economic growth now, partially in response to what we saw during those years, but also partially as a kind of a follow-on, if you will. For a long time, interest rates were very, very low. That tends to be very positive for the market. It tends to also be positive for the economy. As interest rates have gone up a little bit, most people think that that's bad. And a lot of people would say, well, when interest rates go up, it makes it more expensive to do things like borrow money for your business and so on and so forth. And they think that that is going to cause an economic slowdown in every case. But the reality is, what's happened over time is that sometimes when interest rates are very, very low, it has a little bit of the opposite effect, and it makes people lose confidence because interest rates tend to go up as the economy gets stronger. So when they're very low, I think the market tends to lose sight of what comes first. Is it the chicken or the egg? Is it interest rates then growth, or is it growth then interest rates? And so they will relate, well, very, very low rates are going to equate to lower economic growth. So things must not be that great if interest rates have stayed this low. So what we've seen in the last couple of years is more of a normalization of the interest rates that are out there, which normalization in this case means they've gone up closer to where they've been historically. And what we at Conning think is that that normalization of rates actually has taken things back to the way they were before the financial crisis, where rates and economic growth are less dependent upon stimulants or stimulating things like lower interest rates, and are more dependent on what can actually be done out there in the economy. And I think it's one of the reasons why we've seen economic growth be somewhat stronger lately relative to how it was for a long time. You know, historians will look back and say, well, was keeping rates that low that long a good thing or a bad thing? And they'll probably never be able to answer the question. But I think that one thing it did for sure was that it did, I think, prevent a worse downturn than we would have had. So that's kind of the history that we have. So where are we now? Right now, we're in a situation where we have relatively strong economic growth. Excuse me. We have inflation that's relatively under control. We have reasonably low unemployment. I guess I should say historically low unemployment, really, but there are still people that are not looking for work that need to get brought back into the workforce, I think, before that really becomes quite as beneficial as it would normally be. But still, it's a very low number. And I think that the questions that we have in common are what could happen, what could go wrong. So a trade war, that could be bad, right? That could go wrong. Currently now, it just seems like we're walking a little bit of a tightrope on whether we're going to have a trade deal with China that is beneficial, or a trade deal with China that's bad, or a trade deal with China that just doesn't happen at all. And I guess we'd call that sort of our Goldilocks scenario, and then like the Papa Bear and the Mama Bear scenarios. I guess a lot of economists would say better a bad deal than no deal, because if nothing else, it takes away the uncertainty, and the economy hates uncertainty, really hates it. The markets hate uncertainty. So we'd rather have a bad deal than no deal, but we'd much rather have a good deal than a bad deal. And I think that, you know, our forecasts are that we're still looking at something that would at least look like a good deal. And that's from the Conning sort of economist perspective. So we're hoping for that. We're hoping that interest rates stay about where they are now, because I think that if they go higher, they could have a little bit of a slowing effect on the economy. But where they are now, it's still relatively attractive in terms of people's ability to get financing and to borrow money. So historically, they're low. It's just that compared to the recent history, they're pretty high, actually. It was funny. Earlier today we were talking about debt levels and the fact that there are higher levels of debt out there, especially for individuals. Some at the company level, but that on the one hand you think that that's not a very good thing for people to be overborrowed and not to be able to potentially pay their bills. But what struck me is that number's really gone up recently. And one of the things I always thought back in the day, that post-financial crisis, was as inexpensive as you make it to borrow money, if you don't have confidence that you're going to have a job the next day, you're not going to borrow money. They can give it to you for 0% interest rate, and you wouldn't want to borrow it. But because of in a way, this buildup of debt has been because people have gotten the confidence back to actually borrow money. And it's just another one of those two-edged swords that you see all the time when you're in economics. It may not be good for people to borrow more money, but the fact they're willing to is a somewhat good sign. So I wish they always make a joke about the free-handed economists, because they always say, well, well, then here's what we think, and then on the other hand, they think that they're going to get you the answer if they get 3 shots at it. But by and large, we think that the combination of strong economic growth, low inflation, relatively low interest rates, and a lot of economic activity will generally be good for the equity markets. And we would, before the end of the year, we're forecasting something like a typical return to the stock market, something like 7 to 9% returns. How you get there can look a lot like this, but it's really, we're trying to say from here to there, we're looking at a total return of 7 to 9%. But since that's an average, it could be significantly higher, it could be significantly less. But one thing is true, when you sit down and you look at the numbers, strong economic growth almost always means a relatively strong stock market. Are there any questions? I know I've covered a lot. I think I bounced around a lot, so I apologize for that. I hope that was somewhat coherent. But
They say that China's got more to lose in this trade deal than we do. How do you feel about that?
I think that's true. They have a huge amount of their export economy that's dependent upon the U.S. And it's the flip side of everybody complains that we import way more from China than we export. Well, that's not good. But the flip side is, if they couldn't export to us anymore, it would harm them a lot more. It would harm us. I've always, and I agree with that. Unfortunately, I guess I'll give you the other-handed argument now, and that is that I'm not sure I have the confidence in the Chinese government to care enough about whether it harms their people or not.
Right. Yeah.
I think the U.S. government is fairly answerable to the people. Chinese government isn't so much. I think that's a big wild card.
How is our economy doing? And I agree it's not doing good.
It's supposed to be slowing.
Yeah.
It's supposed to be slowing. Most people outside of China realize that a lot of what China publishes about economic growth are exaggerations. But even their exaggerated numbers are looking less strong, so we just assume that the real numbers are going down too.
So question?
So any ripple effect from Brexit?
Oh, that's funny. I was out of the office. I was in New York City the day that happened, and I got up and I didn't really turn on the newspaper or turn on the news. And then somebody told me that they voted to Brexit, and I was floored. I couldn't believe that anything could happen because I didn't expect that to happen. But I think the only people are in the UK.
You don't think it'll handle the world markets? It'll be minimal impact.
Yeah, I think so because they just aren't as big as they used to be in relative terms. 100 years ago would have been a big problem.
It feels like a lot of global nationals are pulling headquarters out of the UK. Right? They're trying to find other locations. So I think you're right. It's going to help. It's going to hurt their economy first. And I don't know. We're not sitting on an island here in the U.S., but probably less significance to us.
Very large island over here.
Yes, yes.
It's called the Western Hemisphere.